Everyone tells you the secret to wealth is finding the right stock, the right moment, the right tip from the right person at the right time. They're wrong. Completely, catastrophically wrong. The secret to wealth has never been about information. It's about temperature. The investor who stays cold when the world is on fire wins. Every time. Without exception. And the maddening truth? The tools to achieve that coldness were written down over 2,000 years ago by a man who had never heard of a stock ticker, never seen a Bloomberg terminal, never watched CNBC at 3 a.m. in a cold sweat. His name was Marcus Aurelius, and he understood markets better than 99% of Wall Street. Here's the paradox that will reframe everything you think you know about investing. The more intensely you feel about your portfolio, the worse your returns will be. Not slightly worse, dramatically, measurably, mathematically worse. Your passion is not your edge. Your passion is your liability. The market doesn't reward the most enthusiastic. It rewards the most unmoved. Think about a gyroscope. You've seen one. That spinning top that refuses to fall over no matter how hard you push it, no matter what angle you tilt it at. The faster it spins, the more stable it becomes. The more force you apply to knock it off balance, the more powerfully it resists. That's not magic. That's physics. Angular momentum.
Look at the binaries.
The gyroscope doesn't fight the force. It doesn't panic. It doesn't react emotionally. It simply spins. And the spinning itself creates the stability. This is the metaphor that will run through everything we discussed today. Because the financially stoic investor is a gyroscope. The news cycle pushes. The Fed speaks. Inflation spikes. A war breaks out. A bank collapses. And the gyroscope investor keeps spinning. Not because they're ignorant of the chaos, not because they don't feel it, but because their internal momentum, built through philosophy, practice, and system, is stronger than any external force the market can generate. The Stoics called this apatheia, not apathy in the modern sense, not laziness, not indifference, not caring. Apatheia meant freedom from being ruled by your passions, the ability to observe your emotions the way a scientist observes a specimen, with curiosity, with distance, without being consumed.
Epictetus, who was born a slave and became one of the most influential philosophers in history, put it this way: men are disturbed not by the things which happen, but by the opinions about the things. Read that again, slowly. The market dropping 30% doesn't disturb you. Your opinion about what that drop means disturbs you. And that opinion, that story you tell yourself in the moment of panic, is the most expensive thing you will ever buy. Let's talk about what's actually happening in your brain when the market crashes. Because this isn't philosophy. This is neuroscience. And understanding the mechanism is the first step to escaping it. Your amygdala, the ancient reptilian alarm system buried deep in your brain, cannot distinguish between a bear attacking you in the forest and a red number on your brokerage app. To your amygdala, loss is loss. Threat is threat. When your portfolio drops 20%, your brain releases the same cocktail of cortisol and adrenaline that your ancestors released when they heard a predator in the darkness. Your heart rate increases. Your vision narrows. Your prefrontal cortex, the part responsible for long-term thinking, rational analysis, and impulse control, goes partially offline. You are, in that moment, not an investor. You are a frightened primate. And frightened primates make terrible financial decisions. This is the first cycle. Call it the Amygdala Tax.
Every time you check your portfolio during a downturn, you pay this tax. Not in dollars, not yet. In cognitive capacity, in rational bandwidth, in the slow erosion of your ability to think clearly about time horizons longer than the next 24 hours. Research from the University of California, Berkeley found that investors who checked their portfolios daily during periods of high volatility made significantly more trades than those who checked monthly, and those trades, on average, destroyed value. Not because the daily checkers were less intelligent, because they were more activated. Their amygdalas were running hot, and a hot amygdala is a terrible portfolio manager. The Stoics understood this intuitively. Marcus Aurelius wrote in his Meditations, a private journal never intended for publication, "You have power over your mind, not outside events. Realize this, and you will find strength." He wasn't writing about stocks.
He was writing about the barbarian invasions threatening the Roman Empire, the plague killing thousands of his citizens, the political betrayals happening within his own court. He was writing about actual catastrophe. And his prescription was the same. The event is not the problem. Your relationship to the event is the problem. The practical exit from the Amygdala Tax is simple, but not easy. Create friction between stimulus and response. Delete your brokerage app from your phone. Check your portfolio once a week, once a month during volatile periods. Not because ignorance is bliss, but because every unnecessary check is an unnecessary tax on your rational mind. The gyroscope needs space to spin. Stop grabbing it. The second cycle is more insidious, more seductive, more expensive. Call it the Narrative Vortex. Human beings are story-making machines. We don't experience reality directly. We experience the story we tell about reality. And the financial media, CNBC, Bloomberg, financial Twitter, Reddit forums, YouTube channels with dramatic thumbnails, is in the business of selling you the most compelling story possible.
And be one.
Not the most accurate
actions
story,
define you,
not the most
not your
useful
words.
story, the most emotionally engaging story. Because engagement is their product. Your attention is their revenue. Your panic is their profit. Here's how the narrative vortex works mechanically. A piece of economic data is released. Say, inflation comes in slightly higher than expected. The raw data point is 0.2% above consensus. That's it. That's the fact. But within minutes, the narrative machine transforms that data point into inflation spiral threatens to destroy the economy. Is your retirement safe? The story grows. Analysts appear on television to explain why this is the beginning of the end. Social media amplifies the most extreme takes because extreme takes generate the most engagement. By the time the story reaches you, it has been processed through 17 layers of emotional amplification. You are not receiving information. You are receiving theater. And here's the devastating part. The theater works. Studies from behavioral economist Daniel Kahneman's research, particularly his work on what he called System 1 and System 2 thinking, show that vivid, emotionally charged narratives bypass our analytical thinking almost entirely. We don't evaluate the story. We feel the story. And then we act on the feeling, believing we're acting on the analysis.
The Stoics had a practice for this. They called it fantasia catalepticae, the gripping impression.
The idea was that before you act on any impression, any piece of information, any emotional reaction, you pause and ask, is this impression accurate? Is this truly what it appears to be? Epictetus taught his students to say, when confronted with a disturbing piece of news, You are just an impression, and not at all what you appear to be. This is not denial. This is interrogation. You're not pretending the news doesn't exist. You're refusing to let the narrative machine's version of the news become your reality without examination. The practical exit from the narrative vortex. Build a pre-mortem ritual. Before you make any financial decision triggered by news, write down the following. What is the actual data point? What is the story being told about that data point? What is the most boring, least dramatic interpretation of this data? What would I think about this in 5 years? This takes 4 minutes. It has saved fortunes. The gyroscope doesn't react to the wind. It processes it and keeps spinning. The third cycle is where most investors lose not just money, but years, decades. Call it the herd gravity well. Gravity is invisible. You can't see it. You can't smell it. But it shapes everything. Drop a ball and gravity pulls it down. Launch a rocket and gravity fights it every inch of the way. The social pressure to conform to the financial behavior of the people around you is exactly like gravity. Invisible, constant, enormously powerful, and almost entirely unconscious. Here's the mechanism. Human beings evolved as tribal creatures. For 200,000 years, being part of the group was survival. Being excluded from the group was death. Your brain is therefore wired at a deep, pre-rational level to monitor what the group is doing and to align with it. This was adaptive on the savannah. It is catastrophic in financial markets. Because in financial markets, the group is almost always wrong at the extremes. The group buys at the top when euphoria is universal and prices are highest. The group sells at the bottom when panic is universal and prices are lowest. The group is a perfect contrarian indicator, and yet the gravitational pull toward the group is so powerful that even sophisticated investors, people who know this intellectually, get sucked in.
Warren Buffett has said it more plainly than anyone. Be fearful when others are greedy, and greedy when others are fearful. This is not a clever aphorism. It is a precise description of how to escape the herd gravity well. But knowing the prescription and actually taking it are separated by an enormous psychological gulf. Because when everyone around you is selling, when your colleagues are liquidating, when financial media is screaming catastrophe, when your neighbor is telling you he moved everything to cash, the gravitational pull to join them is almost physically overwhelming. The Stoics understood social pressure as one of the primary threats to virtue and clear thinking. Marcus Aurelius wrote, "The first rule is to keep an untroubled spirit. The second is to look things in the face and know them for what they are." Looking things in the face means seeing the herd for what it is, a collection of frightened amygdalas, each amplifying the fear of the others, creating a feedback loop of panic that has nothing to do with the underlying value of the assets being sold. The 2008 financial crisis, the COVID crash of March 2020, the dot-com collapse. In every case, the investors who escaped the herd gravity well, who had the internal gyroscopic momentum to keep spinning while everyone else fell over, captured extraordinary returns in the years that followed. The S&P 500 fell 34% in 33 days in March 2020. By the end of that year, it had fully recovered and was at all-time highs. The investors who sold at the bottom locked in permanent losses. The gyroscopes held. The practical exit from the herd gravity well. Write your investment thesis before the crisis, not during it. Before volatility hits, document in writing why you own what you own, what would have to be true for you to sell, and what price decline you are prepared to tolerate. Then, when the crisis comes and the herd is stampeding, you don't have to think, you consult your document. Your past rational self speaks to your present frightened self. This is not a trick, this is architecture. You are building a structure that can withstand the gravitational pull of mass panic. The gyroscope pre-spun. The fourth cycle is the quietest, the most polite, the most devastating. Call it the comfort compound. Everyone knows about compound interest. Einstein allegedly called it the eighth wonder of the world, though historians debate whether he actually said it. The math is undeniable.
Money invested and left alone grows exponentially. Time is the engine. Patience is the fuel. But there is a dark mirror to compound interest that nobody talks about. Call it the compound of comfort, the compound of avoidance, the compound of, I'll deal with this when things calm down. Here's how it works. You experience a market downturn. It's uncomfortable. So you do nothing. Not because you've made a rational decision to hold, but because making a decision feels too painful. The discomfort of deciding is greater than the discomfort of avoiding. So you avoid. The market recovers. You feel relief. Your brain registers, avoidance worked. Next time there's discomfort, avoidance is the first tool your brain reaches for. Over time, this compounds. You avoid rebalancing your portfolio because it requires confronting your losses. You avoid increasing your contributions because it requires confronting your spending. You avoid learning about your investments because the learning itself is uncomfortable. Each avoidance is small. Each avoidance feels reasonable, but they compound. And what compounds is not wealth. It is the gap between where you are and where you could be. Research from Vanguard's behavioral finance team found that the average investor underperforms the average fund by approximately 1.5% per year. Not because of fees, not because of bad fund selection, but because of behavioral mistakes driven by discomfort avoidance. Over 30 years, 1.5% per year is the difference between retiring comfortably and working until you can't. The comfort compound is not dramatic. It doesn't feel like a crisis. It feels like reasonable caution. That's what makes it so dangerous. The Stoic antidote is a practice called premeditatio malorum, the premeditation of evils. The Stoics deliberately imagined the worst-case scenario, not to become pessimistic, but to become prepared. If you have already mentally rehearsed the 40% portfolio decline, if you have sat with that discomfort in your imagination, felt it, processed it, and decided in advance how you will respond, then when it actually happens, it is not a surprise. It is not a crisis. It is a scenario you have already navigated. The discomfort has already been paid. The avoidance reflex has no power over a mind that has already faced the thing it fears. The practical exit from the comfort compound. Schedule a quarterly discomfort audit. Once every 3 months, deliberately look at the financial decisions you have been avoiding. Not to punish yourself, not to feel shame, but to name them. Write them down. Assign each one a 30-minute block of time. The act of naming the avoidance strips it of much of its power. The gyroscope doesn't avoid turbulence. It processes it and keeps spinning. The fifth cycle is the one that destroys the most sophisticated investors. The ones who've read the books, the ones who know the theory. Call it the precision illusion. Here is a truth that the financial industry does not want you to internalize. Nobody knows what the market will do next. Not tomorrow, not next month, not next year. Not the analysts with the Bloomberg terminals, not the hedge fund managers with the PhDs, not the economists with the Nobel Prizes. The evidence for this is overwhelming and has been accumulating for decades. Eugene Fama's efficient market hypothesis, for which he won the Nobel Prize in Economics in 2013, demonstrates mathematically that in a market where millions of intelligent, well-resourced participants are constantly analyzing the same information, prices already reflect all available information. Beating the market consistently is not a skill.
It is luck. And luck, by definition, does not persist. And yet, the precision illusion persists. Because the human brain is a pattern recognition machine. We see patterns everywhere, even in random noise. We hear that a particular analyst predicted the 2008 crash, and we conclude that he has special insight. We don't account for the fact that thousands of analysts make predictions, and some of them will be right by pure probability. We don't track the ones who are wrong. We remember the hits and forget the misses. This is called survivorship bias, and it is the engine of the precision illusion. The precision illusion is expensive because it leads investors to trade, to time the market, to move in and out based on predictions that feel certain but are statistically indistinguishable from coin flips. And every trade has a cost, in fees, in taxes, in the bid-ask spread. A study by Brad Barber and Terence O'Dean, published in the Journal of Finance, found that the most active traders underperformed the least active traders by approximately 6.5% per year. The investors who traded the most, who were most convinced of their ability to predict and time the market, destroyed the most value.
The investors who traded the least, who accepted their ignorance of the future and simply held, created the most value. The Stoic framework for the precision illusion is the concept of dichotomy of control. Epictetus taught that everything in life falls into one of two categories: things within our control and things outside our control. What is within your control as an investor? Your savings rate, your asset allocation, your costs, your behavior during volatility, your time horizon. What is outside your control? The market's direction, interest rate decisions, geopolitical events, earnings surprises, recessions, the weather in Iowa affecting crop yields, affecting commodity prices, affecting emerging market currencies, affecting your portfolio. The Stoic investor focuses with laser intensity on the controllables and achieves complete philosophical indifference to the uncontrollables. Not because the uncontrollables don't matter, but because worrying about them consumes the cognitive and emotional resources needed to manage the controllables well. The practical exit from the precision illusion. Automate the controllables. Set up automatic contributions to your investment accounts. Set a target asset allocation and automate the rebalancing. Choose low-cost index funds that don't require you to predict anything. Then, and this is the hardest part, stop. Stop trying to optimize. Stop trying to time. Stop trying to predict. The gyroscope doesn't try to control the wind. It controls its own spin. And the spin is enough. Now, let's talk about what the research actually shows about the investors who master these 5 cycles. Because this is not theoretical, this is documented. A landmark study by Fidelity Investments, one of the world's largest asset managers, analyzed the performance of all their accounts over a multi-decade period to identify which accounts had the best returns. The results were startling. The best performing accounts belonged to investors who had forgotten they had the accounts. Literally, people who had died and whose accounts sat untouched. People who had simply forgotten to log in. The second best performing accounts belonged to investors who checked their accounts the least frequently. The conclusion is uncomfortable for an industry built on active management and constant engagement. The optimal investment strategy for most people, most of the time, is to invest systematically, diversify broadly, minimize costs, and then do nothing.
The gyroscope, once set spinning, performs best when left alone. This is what the Stoics called amor fati, love of fate. Not passive resignation, not giving up, but a deep philosophical acceptance of what is, combined with focused action on what can be changed. The Stoic investor does not love market crashes, but they accept them as inevitable, as necessary, as the price of admission to the long-term returns that markets generate. They do not fight the crash. They do not panic at the crash. They observe the crash with the detached curiosity of a scientist watching a predictable natural phenomenon. Because that's what it is. Markets have crashed. Markets have recovered. This has happened, without exception, throughout the entire history of financial markets. The crash is not a surprise. It is a scheduled event whose timing is unknown, but whose occurrence is certain. Let's talk about the practical architecture of financial stoicism. Because philosophy without practice is just poetry. Beautiful, useless poetry. The first pillar is what the Stoics called ascesis, disciplined practice. Financial stoicism is not a mindset you adopt once. It is a practice you maintain daily. And like any practice, it requires structure. Build a weekly ritual. 1 day per week, spend 20 minutes reviewing your financial situation. Not your portfolio performance, your financial situation. Your savings rate, your spending, your progress toward your goals. This is the controllable domain. This is where your attention belongs. The portfolio performance review happens monthly, at most, and it happens with a specific protocol. You look at the numbers, you compare them to your written investment thesis, and you ask one question. Has anything changed that would alter my long-term thesis? If the answer is no, and it almost always is no, you close the app and go live your life. The second pillar is memento mori. Remember that you will die. This sounds morbid. It is, in fact, liberating. The Stoics used the contemplation of death not to become depressed, but to gain perspective. When you remember that your time is finite, that you have perhaps 30,000 days on this earth, and you've already spent many of them, the question of whether the market is up or down today becomes almost comically small. The investor who has genuinely internalized their own mortality does not panic at a 20% correction. They think, I have 25 years until retirement. This correction will be a footnote in the history of my portfolio. What matters is that I stay invested, stay disciplined, and don't let a temporary price decline become a permanent loss of capital. Memento mori is not pessimism. It is the ultimate long-term thinking tool. The third pillar is sympathia, the Stoic concept of interconnectedness. The Stoics believed that everything in the universe is connected, that individual events are part of a larger pattern, that the wise person sees the whole system rather than fixating on individual moments. For the investor, this means developing what we might call systemic vision, the ability to zoom out, to see the current market panic not as an isolated catastrophe, but as one data point in a 200-year history of markets that have always, eventually, recovered. To see the current economic uncertainty not as unprecedented, but as the latest iteration of a cycle that has repeated throughout human history. Systemic vision is the antidote to the tunnel vision that panic creates. When your amygdala narrows your focus to the red numbers on your screen, systemic vision forces your eyes back to the long arc of history. And the long arc of history is unambiguous. Patient, disciplined investors win. The fourth pillar is logos, reason as the governing principle. The Stoics believed that the universe is governed by logos, a rational principle that underlies all things. For the investor, logos means building a rational framework before the emotional storms hit, and then trusting that framework when your emotions are screaming at you to abandon it. This is your investment policy statement. Write it when you are calm. Write it when the market is quiet. Write down your goals, your time horizon, your risk tolerance, your asset allocation, and the specific conditions under which you would change any of these things. Then, when the storm comes, and it will come, you don't make decisions. You consult your logos. Your rational framework speaks. Your emotions listen. The fifth pillar is koinonia, community. The Stoics were not hermits. They believed in the importance of community, of surrounding yourself with people who share your values and reinforce your practice. For the investor, this means being deliberate about your financial community. Who do you talk to about money? Are they gyroscopes or weather vanes? Do they reinforce long-term thinking or amplify short-term panic? The research on social influence in financial decision-making is clear. We are profoundly affected by the financial behavior of the people around us. If your social circle is constantly discussing the latest market panic, constantly trading on tips, constantly reacting to news, their anxiety will become your anxiety. Their behavior will pull you toward theirs. Build a community of gyroscopes. Find investors who think in decades, not days. Read the letters of Warren Buffett, the writings of John Bogle, the philosophy of the Stoics. Let their voices be louder in your head than the voices of the panic merchants. There's a concept in physics called resonant frequency. Every object has a natural frequency at which it vibrates. When an external force matches that frequency, the vibrations amplify, sometimes catastrophically. This is why soldiers break step when crossing bridges. The synchronized marching could match the bridge's resonant frequency and cause it to collapse. The financial media is trying to find your resonant frequency. It is trying to vibrate at exactly the frequency that will cause you to collapse, to panic, to sell, to make the emotional decision that generates the headline, that generates the next wave of panic. The financially stoic investor has changed their resonant frequency. Through practice, through philosophy, through the deliberate construction of a rational framework, they vibrate at a frequency that the market's noise cannot match. The external force hits, the gyroscope keeps spinning. Let's be precise about what financial stoicism is not. It is not passivity. It is not ignoring your finances. It is not pretending that risk doesn't exist. The Stoics were not passive. Marcus Aurelius led armies. Seneca built an empire of influence. Epictetus taught thousands of students. They were intensely active in the domains they could control. Financial stoicism is the same. You are intensely active in building your savings rate, in optimizing your costs, in constructing a rational asset allocation, in educating yourself about the principles of long-term investing. You are completely, philosophically indifferent to the things you cannot control. The market's daily movements, the Fed's next decision, the geopolitical event that nobody saw coming. This is not laziness. This is precision. You are concentrating your energy where it can actually produce results, and refusing to waste it where it cannot. The mathematics of this precision are staggering. Consider two investors, both starting with $10,000, both earning the same average market return of 7% per year over 30 years. Investor A stays fully invested throughout, including during the 3 major crashes that occur over that period. Investor B, driven by panic, moves to cash during each crash and misses the 10 best days of market performance, which, historically, tend to cluster around the most volatile periods. Investor A ends with approximately $76,000. Investor B, having missed just 10 days out of 10,950, ends with approximately $38,000. Half. The cost of panic is not the crash itself. The cost of panic is missing the recovery. And the recovery always comes. Always. The gyroscope that keeps spinning through the storm is the one that captures the calm that follows. Seneca wrote, "It is not that I'm brave. It is that I know what is worth fearing." This is the heart of financial stoicism. The financially stoic investor is not fearless. They feel the fear. They feel the pull of the herd. They feel the seductive certainty of the narrative machine.
They feel the discomfort of watching their portfolio decline. They feel all of it. And then they ask, is this worth fearing? Is a temporary price decline in assets that have always recovered worth the cortisol, the sleepless nights, the impulsive decisions that will lock in permanent losses? The answer, examined rationally, is always no. The fear is real. The threat is not. And knowing the difference is the entire game. The ancient Stoics had a word for the person who had achieved mastery of their inner world. Sophos, the sage. The sage was not a perfect being. The sage was a human being who had developed, through years of practice, the ability to respond to the world from a place of reason rather than reaction. The financially stoic investor is not trying to become a sage. They are trying to move, incrementally, in that direction. Every time you consult your investment thesis instead of panic selling, every time you turn off the financial news and go for a walk, every time you automate a contribution instead of trying to time the market, every time you zoom out to the 30-year chart instead of fixating on today's red numbers, you are moving toward the sage. You are adding angular momentum to your gyroscope. You are making yourself harder to knock over. The market will crash again. This is not pessimism. This is arithmetic. Markets have crashed approximately every 3 to 5 years throughout their entire history. The next crash is coming. You don't know when. You don't know how deep. You don't know what will trigger it. But you know it's coming. And you have a choice. Right now, in this moment of relative calm, you can wait for the crash to decide how you'll respond and let your amygdala make that decision for you. Or you can decide now. You can build your framework now. You can spin your gyroscope now while the conditions are favorable, so that when the storm hits, you are already moving, already stable, already unmovable. Marcus Aurelius wrote his meditations during a plague that killed 5 million people, during wars that threatened the empire he was responsible for, during personal losses and political betrayals that would have broken most people. He wrote them not for publication, not for posterity, but for himself, as a daily practice of returning to reason, returning to principle, returning to the things within his control. He was not always successful. He was human. But the practice itself, the daily return to philosophy, was the gyroscope. The spinning was the stability. Your financial life is not the Roman Empire. The stakes are lower, but the mechanism is identical. The daily practice of returning to your principles, your investment thesis, your time horizon, your rational framework, is the spinning. And the spinning is the stability. Not the market's direction, not the Fed's decision, not the headline, the spinning. The door is open. It has always been open. 2,000 years of Stoic philosophy pointing directly at the mechanism of financial peace. The physics are on your side. Time, compounding, and the historical tendency of markets to reward patience. The biology is workable. Your amygdala can be trained. Your prefrontal cortex can be strengthened. Your resonant frequency can be changed. The mathematics are unambiguous. The investors who stay invested, who minimize costs, who ignore the noise, who let the gyroscope spin, they win. Not sometimes, not usually, consistently, measurably, mathematically. You don't need more information. You need more temperature. You need to be colder when the world is hot, calmer when the world is panicking, more certain of your framework when the narrative machine is screaming that everything is different this time. It is never different. The mechanism is always the same. Fear amplifies. Panic sells. Recovery rewards the patient. The gyroscope wins. Spin and keep spinning.